What if I told you someone studied the 1987 stock market crash here in America, included the actual danger wasn't the crash itself? It was what governments would do next. And if they were right, it could actually help explain why Bitcoin, gold, and other hard assets are so important decades later. So just stay with me because many traders never learned this lesson. So after the 1987 crash, many people feared another 1929, right? Now that makes sense. The markets had collapsed, panic was everywhere. People were nervous, what's coming next, right? And people were comparing it to the next Great Depression. But some people in the market were like, no, the policymakers have learned the mistake from the 1930s. They believed governments would do almost anything to avoid a deep recession. Now, here's where this actually gets interesting. The fear was no longer a lack of liquidity. The fear was what happens when there is too much liquidity. Think about it for a second. Most people are worried about what? A stock market crash, right? Things just drop. But some investors worry what happens after the rescue. You catch the point? So not the crash, the rescue. The price will follow liquidity more often than it follows the news event. So most beginner traders spend their day looking at the news, and that's fine. That's good. I guess, if you're trading, but money's moving through the system. That often matters more than what you're just looking at in the news. Where is it going? Where's the money going? Where is it leaving? Which assets are attracting capital? That's often a more useful question than predicting tomorrow's candle. So think about that. In the 1987 stock market crash, that was when it was more obvious the world was bridged. A problem in one country could basically move to another country. That sounds familiar, right? Today, that bridge is even more powerful. So a move in, let's just say, a bond market in Asia can impact US stocks. A change in the Chinese economy can impact commodities. A shift in the dollar can influence Bitcoin, right? Never study an asset in isolation because it's not. So Bitcoin traders are just looking at one thing, but also look at liquidity. Stock traders should also look at bonds. Commodity traders should also look at currencies. The biggest moves often start exactly where you're not paying attention. Okay, now here comes the part that actually may catch your attention. So back then, Japan was basically becoming more important in the global financial system. And most Americans at that point were just focused on America. But then there were huge forces that were getting built overseas. And some of the biggest W's appear where the crowd wasn't looking. So most people were just looking at their own economy. Most people only follow the stocks that everyone knows. Most people only buy after it's popular in the news and it's obvious. But fortunes are often made by identifying the major trend before it becomes what? Popular. That's one reason we spend so much effort studying the global markets, right? Now, it's not because America's bad, right? It's not because you should bet against your own country, right? But because too much concentration creates what? Risk. Diversification creates what? Choices, options, right? Now let's go deeper. One of the most fascinating thoughts from this, thinking is that what does governments do during a crisis? Do they protect their currency? Do they protect economic growth? And historically, they may choose growth. Why? Because recessions hurt voters. The job losses hurt voters. Market crashes hurt voters. You get where I'm going? Don't ask what governments say. Ask what incentives they have. That one lesson alone can help you avoid a lot of confusion, because markets don't always react just to the words. Markets will react to actions. Now, let's think about today. We have global debt levels that are enormous, right? We have governments around the world that are facing slowing growth. We have central banks that are facing difficult decisions. And investors are trying to figure out, where does capital flow next? Could Bitcoin be one that benefits? Or could gold benefit? Could certain foreign markets benefit? Could some assets surprise everyone? Maybe, maybe not, right? Like, we're looking at all of this stuff. But these are the sorts of questions that if you're a professional trader, maybe you're asking, or you should ask. Because the biggest stock market opportunities at this point are not like, hey, look at me, look at me, look at me, with a big flashing sign. They just pop up and they just come to the party, and they don't say hello to anybody. And if you're not distracted, you'll miss it. They arrive when most people at that party are arguing about something or just having fun, and they're missing the larger trend. And that's exactly why studying history patterns is important, not because history, repeats perfectly, but because human behavior repeats. Fear repeats. Greed repeats. Policy mistakes repeat. And occasionally those clues to tomorrow are hiding in events that could happen decades back and have happened. So if you want to learn how to track global trends, crypto, China, macroeconomics, stuff that many traders might not discuss, you could join our community. We'd love to have you, because we're not trying to predict every candle. We're trying to understand the forces moving markets earlier than the crowd notices them.